Yeah, we spoke about winter last time, and lo and behold, we have a winter in the stock market, which reminds me of what Mark Twain once said, which was, "It's not what we know which gets us into trouble; it's what we think we know for sure, which ain't so." What do you think of what has panned out in the last 2 3 days? Hi, and welcome to another episode of Mind Over Markets. I'm Anand Vardarajan, and with me, as usual, is Rahul Singh. Hi, Rahul. How are you doing?
Hi Anand, good to have you back. What a difference a week can make.
Yeah, we spoke about winter last time, and lo and behold, we have a winter in the stock market, which reminds me of what Mark Twain once said, which was, "It's not what we know which gets us into trouble; it's what we think we know for sure, which ain't so." What do you think of what has panned out in the last 2 3 days?
Yeah, that's so right. In fact, there had come a point that equity markets had forgotten what risk is and how to price risk, and the risk is not getting priced at all. And to that extent, this is a good kind of a rap on the knuckle, if you will, for the markets to just realize that risk will never come announced. It'll come always unannounced. So as the valuations keep going up, you have to keep evaluating risk. So I think that's the biggest kind of takeaway. I know it's a little philosophical, but but that's the way it is.
Yeah, I think with that kind of a cut, people tend to become philosophers. But shifting gears, how do you see what's playing out? Is there a change? We definitely know there's a big shift in the market, which is in play right now. But is this going to lead to more opportunities? Some unloved sectors coming to the fore, and some really loved ones kind of losing sheen.
Yes, you're right. I think what had begun to happen was that the market was getting a little lopsided in its love for certain parts of the economy, which are doing well. There's no doubt about capital goods and manufacturing and industrials in general doing well. But it was getting a bit too much in terms of valuation in certain pockets of these. So to that extent, this is a good check or will act as a safety valve, because what will get questioned now is the valuation and whether the valuations are justified in certain pockets of these cyclical sectors. So it's not that it is the end of the cycle and it is going to lead to a decline or some kind of a reversal in the cycle, but clearly from a valuation point of view, it will not get unquestioned. And a little bit of indiscriminate valuation re-rating which some parts of the market had seen will temper down. That's number one. Number two is that there were certain sectors which are doing well, maybe not doing as well as the cyclical parts, which will start to get more flows and attention. And I would say banking, pharma, consumer, in that order, I think will come into play. Not so much because of lack of options, but because some parts of these markets are looking attractively valued, as well as there are triggers for growth to resume or growth to surprise. Bottom line is that it will lead to a much more balanced market, which is what we want if we need to sustain this run which we have seen for longer. What would have happened otherwise is that if this valuation re-rating had gone completely unchecked, it would have led to a bubble, and then you spoil the returns for the next 2 3 years.
So there are two parts to what you said, which is one on valuation side, and with these kind of numbers that we are seeing in terms of the election outcome, do you the other part, which is politically, what is there a shift of focus? Will there be? Do you expect a slip or slightly loosening of fisc and more social spends, and maybe that could mean some cut in infra spend and so on? Is that something which is triggering this thing, or is there sympathy, low valuations, not done well, doing the right stuff but still lying low, and hence that can come. So what is the trigger for what has not done well so far to kind of do well?
Right. So that's a very good point, and that's like digging deeper into what I just said. You're right that the fear of a little bit of a shift in the fiscal priorities, which had been last 2 3 years towards infrastructure and capex spending, that fear is definitely going to enter the minds of the investors, and rightly so, because coalition politics has its own compulsions. We all know that. And also, parts of the rural economy are really not showing signs of too much growth. So there is potentially a demand which can be raised towards that front. And therefore, once that happens, if that happens, and even if that does not happen, the probability of that happening has gone up. And it's all about probability. So if the probability of that happening has gone up, you will see, in order of priority, as I said, certain parts of the sectors which I mentioned, specifically consumer, might also start coming into the picture, into the play, because this is a sector which has not done well last 3 years pretty much, barring few stocks. Also, what has happened in the consumer sector is that this was traditionally viewed as high quality sector, and therefore used to enjoy a premium over the market and over the other parts of the market. That premium has shrunk. It's not at its bottom point in terms of, if you look at a 20-year history, but the premium has shrunk significantly. So potentially it is a time when, if we are able to find certain consumer pockets or parts of the spending which start to look up, and if the companies are executing well, there will be more openness from the market to look at those ideas now versus earlier. And on the flip side, yes, if the infrastructure spending, if there is a little bit of a slowdown there, or if the union budget, which will be in a month's or 1.5 months' time, gives even a small signal towards that, then it could lead to further deepening of those fears which we are just talking about.
But just on banking, because you mentioned, some of these things like farm loan waivers, etc., which was up until now not there. Do you think some of these could be back on the table, and hence, up until now, the good work which we've seen, does that kind of take some sheen away from, especially the PSU banks? One, of course, valuations have been quite high, and some of these things, if they come back on the table, then?
Well, it's difficult to say. I would think that is still a lower probability event than just pure support to the rural incomes. So that's probably a second level of fear which you're talking about. So I think the probability of that is low, but obviously we cannot rule it out. What will become important in a coalition kind of a scenario is that I think the markets will then also start watching the election calendar much more closely. So when is the next state elections? When is the next round of big state elections? Will there be a negative, some negative announcements pre those? So that's not something which we are not used to seeing it for the last 3-4 years, and therefore that could come back. And therefore some amount of derating for some sectors like PSU banks cannot be ruled out completely.
It's interesting. I mean, you mentioned it, because up until now, be it the largest of states, we've not seen any kind of a loosening on fisc, which perhaps could become a reality, which as the year progresses. So assembly elections also takes far greater importance than So within our set of funds, given the kind of shifts which has happened, how do you see what looks good? Is it the same prescription, or the prescription's changing because the weather's changed?
No, I think the prescription was always towards large cap having better risk reward. So that gets further reinforced in my view. We anyway had talked about banking and pharma. I think that gets further reinforced. So what we thought would play out over a longer period of time, what this result does is to force the issue really, and to force the market to acknowledge that there could be pockets which are overvalued, there could be pockets which are showing progress. We are not looking at that, and therefore, as I mentioned in the beginning, I think the markets will become more balanced. So the other subtle point in this is that any portfolio which is built bottom up in this scenario will tend to do much better than more sector focused or a top down focus fund. What I mean by that is that when the markets become balanced and when there is very little to choose between sectors, because the sectors which are doing well have also got uh, fairly valued or overvalued, what will make difference is stock picking. And therefore, after being in a momentum, more thematic kind of a market last 18 months or 24 months, we might be returning to a stock pickers market for the next 12 to 18 months. I think that's the other kind of takeaway from what has happened this week.
And I think what we've noticed is coalition or majority governments markets have the ability to climb walls of worry. So, and if past is any indication, markets have seen all of that. Any thoughts on that?
So yes, but I think markets have been climbing wall of worries for the last 18 months, and this is a fresh wall. So how many walls can you climb, right? And these kind of events are forces you to think over a longer period of time. You will see within that, ups and downs, but maybe again sitting 2 years later or 18 months later, we would probably be saying that this was one of the inflection points. Not a huge inflection point or a huge turning point, but a turning point for good, because the markets became more balanced after that.
Excellent. I think that's all the time we have. That's a wrap on this episode. Till next time, see you. Thank you, Rahul.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.